because I may lose you with my internet down here.
Okay, you're good to go.
Okay, hello everyone on a cold day from Toronto, but the sun's out. I'm Louise Barabee from NABS, and it's my pleasure to introduce you to Monique. She's the head of financial life strategies at U Potential, and she's also NAB's trusted financial counselor and advisor for more than 10 years. We'll be recording today's session to make it accessible after for anyone that might have missed today's session. And we're going to email everyone after with the link in case you want to go back and forth and look at the materials again as we all try to prepare our taxes. So Monique, you're in good hands. Off to you.
Thanks so much, Louise, and thank you everyone for joining me. I understand that this is, fairly well attended for one of these webinars, and I would love to say it's on my account, but in truth, I know that we're all trying to do our best, especially in a year of what could have been some lean periods, to keep more of what it is that we earn. With reference to something that Louise said in particular about the recording of this webinar, I would encourage you, because taxes in particular and financial planning in general is best done as a household. If you do have a spouse or partner, this would be a great webinar to watch again with that person so that you can make some strategic decisions. Anyway, by way of introduction, my name is Monique Madden, and I'm a certified financial planning professional. I'm a financial management advisor, and I have a specialized degree in financial divorce. I have been specializing in personal finance for, I'm afraid to say it, about 2 decades now. And I actually have been partnering with NABS for nearly that long. If we haven't spoken yet, you might find my approach to be a little bit different than you're used to, because I actually have an undergraduate degree in neuropsychopharmacology, which is drug interaction on the brain. So when I look at financial planning, I'm looking at it through the lens of providing insight and strategies to help people get to their goals. I've worked with dozens upon dozens of NABS clients, working, both proactively before something happens and when necessary, helping people during make tough decisions during industry downtimes as well. Today, we're going to be working on the tax system, how it normally is, and then we're going to specialize a little bit in some of the realities that are related to the pandemic, because, a tax webinar in 2020 or 2021 would be remiss without such a thing. So I've actually delivered these seminars for well over 15 years, and I find that it's often very helpful to start with a cursory review of the Canadian tax system, just so that we're all on the same wavelength and everyone is brought up to speed, no matter how accustomed you are to, common features of our tax system. Then we're going to talk about some special considerations for the realities of the day. And finally, we're going to look at setting yourself up for success proactively so that we can put ourselves into the best position possible for the future. So let's get started. First and foremost, when I teach people about the Canadian tax system, I try to encourage them to have a positive and cooperative relationship with the Canada Revenue Agency. All a tax return really is it allows you to present more information about yourself than was used originally to calculate your source deductions. Basically, it's a process of you presenting information, maybe the Canada Revenue Agency asks for more information or challenges something, and it's a kind of an information back and forth, a conversation. What I want to assure you, though, is that you have rights in the tax system. And even if you receive a notice of reassessment or a challenge, don't get too concerned. Take a deep breath. There is no immediate threat to you or to your family. And really, the best thing that you can do is simply provide the additional information in a timely manner. For most Canadians, the taxes that are remitted on your behalf by your employer are really based on very fundamental information. So, what does your employer really know about you besides your age, how much you earn, and how frequently you're paid? Everything else is extrapolated. And so, in the simplest of situations, the amount that's remitted on your behalf is neither too much or nor too little. And you would pretty much come out even when you report your taxes with very little refunded or very little owed. Of course, it should come as no surprise that the tables from which the payroll departments calculate those source deductions doesn't always get it right. The payroll remittance process, as you can imagine, simply can't take every Canadian's individual circumstances into consideration. Taxes are usually owed because of additional employment sources, if you have taxable investment income, if you collect spousal support, or you have a rental property that you collect rental income from. All of those factors could contribute to pushing you into a higher tax bracket, which we'll discuss. The opposite, refunds, happen when your personal circumstances lend themselves to some sort of tax relief. And this could come because of, let's say, good habits like making RSP contributions or charitable donations, or because of personal circumstances. So there could, as might have happened this year, been a period of time where you were unemployed or furloughed, or for different kinds of personal circumstances like a disability, medical expense, or perhaps, you're the primary income earner and have dependents. For self-employed people, the calculation and remittance is a fair bit more complicated because you also have to take into consideration the costs of doing business. So for most employees, this is not something we've ever had to worry about. This year, that's wholly different because even regular employees who would have normally gone to a workplace have what I'm sure you've heard about is an expanded opportunity to claim the home office expense deduction, which we'll talk about. Back to self-employed persons, anyone earning more than $30,000 a year in self-employment income is also compelled to collect and remit either GST or HST, depending on the province that you work in. More importantly, and this is something that a lot of self-employed people get into trouble with, if you're self-employed, you're collecting income directly from your customers. That income is on a pre-tax basis. So it can be very tempting not to reserve some funds for taxes, or in cases of, let's say, a sales slump, to dip into the tax reserve. And I'm not going to demonize that at all. When the pressure's on, of course you'd understand that you'd dip into that potentially. But that's a level of discipline that isn't required of employees, because whatever hits our bank account, presumably we can spend, or most of it at least. When you're self-employed, what's hitting your bank account is on a pre-tax basis. So it's really easy to get into trouble. But we're going to talk about way more on self-employment a little later in the webinar. By the way, I was remiss at the beginning. I forgot to mention that I'll be taking questions at the end. So if you type up your questions and put them into the chat, one of the organizers will help me address them at the end. So back to, something that's sort of universal for all of us. Fundamentally, the Canadian tax system is a graduated tax system where the first portion of your income is taxed at one rate, and then the next portion is taxed at a higher rate, and so on and so forth. Combined, all of these small incremental calculations result in the total amount that you pay, and the highest tax bracket that you're subject to is called your marginal tax rate. Now, I don't try to add a lot of jargon, but the marginal tax rate actually is a really important term, and we'll go through that again. Once provincial taxes are included in the calculations, the tax brackets don't appear quite this clean or equally spaced in what looks like almost $44,000 increments, more or less, because each province levies taxes in a different way. And for those of you living in Quebec, you of course know that you have an entirely separate provincial tax return that you have to prepare. So let's look at an example. If you were to earn, let's say, $58,700, which is the average income in Canada from last year, and in this particular case, we're going to look at someone who lives in Ontario, then let's say the first $44,740 that this person earns will be taxed at about 14%, as you can see on the right-hand side, percentage levied, resulting in about $6,318. Then another layer, which is a bit smaller, the next $3,795 is taxed at 24%, resulting in an additional, let's say, $916. And the final $10,165 is taxed at 29.65%, resulting in an additional $3,014 in tax, which combine is total tax for this person of about $10,248, or an average tax rate of 17.46. What is important is that this person's marginal tax rate is that last tier that they're subject to. So the 29.65% is this person's marginal tax rate, which becomes important for tax planning. Okay, now one of the reasons why identifying your marginal tax rate is especially important is because in a situation that's becoming increasingly common where people have income from a variety of sources, such as, let's say, a second job or spousal support, as I mentioned earlier, rental income, or even the CERB in this past year, all these things could push you into a different tax bracket. So let's say, for example, this person who in a normal year earns $58,700, their payroll department will remit taxes based on $58,700 in tax for the year. But if that person had a side hustle and earned $5,000 on the side, they don't have to hold on to taxes at 14.12% or 24.15% for that extra $5,000, that person's going to be taxed at 29.65% for the extra $5,000 or more if you happen to be butting up against the next tax bracket. So this happens, more often than you can imagine. The converse is true as well, and this might be particularly relevant in this year. Again, someone earning $58,700, while they were on payroll, let's say appropriate taxes were being withheld at that rate. But if they were furloughed for 15 weeks collecting the CERB, then all of a sudden too much was withheld. So in this particular situation, that person in this year of, let's say, combination of full earnings and social benefits, this person could expect a refund this year because in the end, they probably didn't earn the full amount that would have been taxed at, the highest tax rate in this particular situation. So that's why it's so important to remit your tax return, because it could be that you either owe because not enough was withheld on your behalf or too much. And my guess is for many that latter situation may be the case this year. Unfortunately, the tax system in Canada is quite complicated. But the Canada Revenue Agency website and most tax planning software, if you use it, they really do a really great job walking you through the standard credits and deductions. So we're going to really focus on some things that I think are particularly important for you. And what I've done at the end is I've given you links to some of the resources and websites that might become helpful for you. So recognizing that our healthcare system doesn't cover off all of our needs, the Canada Revenue Agency allows us to claim a credit on additional costs of medications, assisted devices, and things like that. Now, we want to be strategic in how we claim this particular credit because this credit allows you to pool the costs for a household. And the household could be, yourself, a spouse, and some children, although there is a slight discrepancy in the calculation between children who are over 18 and children who are under 18. Nonetheless, you do want to pool those expenses, and it's especially interesting because this is one of the credits that allows a slightly different calculation. So you don't have to calculate your medical expense tax credit based on the expenses that were incurred from January through December. It can be any 12 consecutive months if it should happen that a different 12 consecutive months helps you. So for example, when I was paying for my daughter's braces, the braces were paid in monthly installments that happened to have straddled a calendar year. So rather than claiming some of those expenses in one tax year and some in another, I was able to shift the 12 consecutive month period that I was going to be claiming, which optimized the credit. The other thing that's a little bit different about this tax credit is it's one of those wonky calculations, the lesser of this or that. Because it's a lesser than calculation, it is actually best reported on the lower income earners tax return. Now, since we're sponsored by NABS after all, it's important that we talk about the donation tax credit also. So the donations can be incredibly valuable for tax planning, but there is again a bit of a nuance. So firstly, the first $200 that are donated in a particular year are credited at the lowest tax bracket, but anything in excess of $200 is credited at the highest tax bracket. So what is useful for spouses is to pool their donations, much like we did with the medical expense tax credit, so that you avoid duplicating the lesser valuable first $200 donation. So this will actually optimize the credit for the household. Now, I suspect that this is going to be the most important topic that we're going to discuss today, and that's the reporting of home office expenses. There is a simplified option, which has never been introduced before, and then there's a more detailed method that would be more similar to what some people were able to claim in the past. So what the home office deduction allows you to do is to claim the cost of maintaining your home when your home is also, or a portion of your home is also your office. Most years, there's a huge number of rules about who can claim the deduction and what can be claimed. But in a year as turbulent and complicated as 2020, the Canada Revenue Agency has offered us this simplified option. Using the simplified option, you don't need to have any supporting documentation, and it is a flat rate, which we'll talk about in a minute. If you think that that flat rate is less than you would otherwise be eligible for and you're willing to collect the documentation, there is that detailed method that you can go through and see whether you're going to be eligible for a slightly bigger deduction. Starting with the simplified option, it's basically a flat rate of $2 a day for the days where, or the weeks where you worked at home at least 50% of the time. Okay, and the minimum in order to be able to trigger this eligibility is you have to have worked from home for 4 consecutive weeks. My guess is the vast majority of the people who are on the call today, this is going to represent the majority of their time in 2020. So the $2 per day basically gives you a flat rate deduction if you worked for home for about 40 weeks, 5 days a week for 40 weeks. Requires no paperwork, no receipts, easy peasy. For those of you who do want to have perhaps more complicated situations or a larger portion of your home is being used, there is still the detailed calculation. It's called the T777S, and it requires both the attestation of your employer that you had to work from home, which is called a T2200S, and that you were working from home specifically because of COVID-19, and does require you to have receipts. So now bear with me one second. I'm going to try to do something fancy here, or at least fancy for me. I'm going to try to go through an example with you. So if, again, the Zoom gods have cooperated, you should see a Canada Revenue Agency or Government of Canada website in front of you. And we're going to go through an example of this calculator that could, within a couple minutes, it'll give us an idea of whether the person in this particular situation would be better off with the flat rate application of the home office deduction or the more complicated claim. So let's start off. And again, this link will be at the back of the seminar notes so that you can play with it yourself. So first, we're going to look at 3 different situations that might be pertinent. A flat rate of $2 a day, as I mentioned. Home office expenses that were paid while you were working at home during the pandemic, or home office expenses and other employment expenses to claim for which you have supporting documentation. This last one is probably most pertinent to someone who is, let's say, a commission salesperson. So the simpler of the two is what we're going to go through today. So we're just going to toggle home office expenses, okay, while working at home. So then we go through a short checklist here of things we need to have handy. You have to meet the eligibility criteria, which I mentioned is those working from home more than 50% of your time over at least 4-week period. You need to know roughly the size of the workspace relative to the full square footage or square meterage of your home. You need to have supporting documentation. You need to know that your employer will be supportive of this application, which most would be, and you need to have some information on your income. So let's do an example. So what is your residence situation? Do you rent and you haven't moved? Do you own and you haven't moved? Or did you change your residence or workspaces at some point during the year? So I'm going to simulate here someone, for example, who might be someone who owns a condominium. So let's say own, and we haven't moved during the year. Next, did we earn commissioned income? So I'm going to say no. Okay. What type of workspace do you use? Well, there's a difference between a designated workspace or a common space. So a designated workspace would be a room that you don't use for any other purpose. Let's say a spare bedroom or your basement. Or is it a common space such as, let's say you and your kids are sharing the dining room table, which is, I'm sure, pretty common. It's simpler to work on a designated workspace, so let's try that. Next, do you want to do the assessment in square meters or square feet? Forgive me, I'm an imperial girl. Let's do square feet. Okay. Then we need to calculate what percentage of the home's square footage did you use for work purposes. And incidentally, this is exactly the same as what would have happened if you were self-employed pre-pandemic. This is the kind of calculation you would have had to do. So let's say we're using, you can see that I've already tried this with a client not long ago. Let's say we're using a spare bedroom in a condominium. And let's say it's, 225 square feet, okay? And the total area, let's say, is a 1,200 square foot condo, all right? So what it's telling us right away is that of the eligible expenses, about 19% of them will be eligible for this deduction. Okay. Now, how long did we use the property? We used the property, let's say, from 2020, April 1st. Whoops, sorry about that. 1st through to December 31st. So essentially 9 full months. Okay. Now it's asking you, what are the total electricity, heat, water, and home internet access fees that you paid? Well, let's say between internet and various common element fees from a condo, let's say it was not $4,000, but let's say it was $3,000 over the course of that time. So over the 9 months, more or less $250 a month, or maybe a little bit more. Okay. Other home expenses, this would be if you had to renovate the property to make it suitable for working at home. So I didn't really have anything like that in this particular example. What about maintenance costs? Let's say, did you have to do anything like set up a dedicated line for your internet that you didn't have before or something like that? Let's just assume no. And you can always use this toggle here, what is considered a reasonable maintenance expense, if you need more information on that. Okay, total maintenance expenses for the designated workplace. Again, I don't think it's pertinent to this particular calculation. Okay, then we get to office supplies and employment related expenses. So let's say office supplies that I had to bring in for that period, let's say between courier fees and other stationery, etc., maybe it cost me $120. Any other support that was required from home, use of a cell phone, etc., long distance plans, I personally have my cell phone paid for by my employer, so I'm not going to put anything there. Now, let's assume we're doing an example for someone who earns that national average wage I mentioned before, $58,700, and that this person is not contributing to any union dues or professional fees, and there is no pension plan at this particular workplace. Then what we do, we hit calculate your expenses. And what this does is a rough calculation that the total expenses that this person in this situation could deduct would be about $683, of which $562 are the portion of the use of home, and the other $120 was those postage fees, etc., that I mentioned earlier. Now, one word of caution. My guess is that this is going to be something that is very, very widely used. But the truth is that if you have a workspace that's really, 10 or 15% of the square footage of your home, it may not be worth the trouble. The $400 flat rate might be worthwhile for you. In this particular case, we're looking at, a $1,200 square foot condo, of which, nearly a third of it is being used, or 20% of it is being used for the office. You would need to have a fairly good chunk of the home square footage dedicated to the use for your office for this to be merited. So don't think that it's a slam dunk. I'm certainly to save thousands and thousands of dollars. If I go through the more calculated route, it could very well be that for many, many people, the $400 is going to be enough and not worth the trouble. But I'll, like I said, I'll leave a link to this particular site so that you can play with it and see what's best for you. Okay, back to our presentation then. Let's spend a few minutes on setting yourself up for success for this current tax year, 2021, and beyond. The truth is, we're all hoping the pandemic doesn't linger on, but we're not really getting rid of it as quickly as we want to. But no matter what happens, let's try to set ourselves up for success. Two ways to do that is to make careful tax planning decisions, especially between spouses or partners. And I do want to give you some advice if you happen to find yourself newly self-employed. So I'm hoping that you're aware that the RSP contribution is really the single most valuable tax planning tool for most Canadians. But to optimize the strategy, contributions should be made by the higher income spouse. And this is because, again, when we're talking about the marginal tax rate, that term I introduced to you before, your RSP contribution is refunded to you at your marginal tax rate. So, for example, if you're living with someone else and there's an extra $5,000 in discretionary income for one of the two of you to contribute to your RSP, it would make better sense for the higher income spouse to make the contribution. So in an example where one spouse earns, again, the national average, $58,700, and the other spouse earns, let's say, twice that much, one spouse will fall into that first tax bracket that I've circled there, over $49,020 and up to $79,505, the 29.65% bracket. And the other spouse will fall in as a marginal tax rate, the $98,040, $250,000 tax bracket. This means that that same $5,000 contributed by one spouse would be refunded at 29.65%, or by the other spouse at 43.41. So clearly we want the higher income spouse to make the contribution so that we can have a larger refund. Now, before you go about doing that without further consideration, there are other factors like the contribution that each spouse has, but at least let this be one thing that you consider before making the contribution so that at least those precious $5,000 are refunded to you in the most effective way possible. Now let's spend a few minutes for the newly self-employed, and I'd like to put a positive spin on this. So congratulations on going solo. The key piece of that becomes important for the newly self-employed is that you really do have to keep track of the costs of doing business. And these could vary dramatically depending on the work that you do. If your business is largely to make money off your talents, instead of, let's say, making something or selling a good, then the amounts that you're going to want to be tracking will be similar to the ones that we discussed in the home office expense area, with maybe a little bit of additional accounting for things like replacing computers or depreciation of some assets. If you're a self-employed person, there might be a few other things to keep track of, including the use of your car. And if you actually produce something like a good for sale, then you'll also want to keep track of the raw materials. Now, rather than going through a whole list of things to track, again, I'm going to include a link in the resources section so that you can go to the Canada Revenue Agency directly and find, the information that you're looking for. A few points of caution. So if you are new at being self-employed, I want you to know that you can't really spend lavishly because things are, quote, a write-off. I hear that all the time. Yeah, I'll order dinner because it's a write-off. Well, it's not quite that simple. So let's take two very common mistakes people make. Firstly, buying a car for the expressed use of your business. Even if you're buying it for business purposes, it doesn't mean that the whole cost of the car is going to be deductible to you. It's really, you have to keep a very detailed log of the time that you spent using it's specifically the mileage, not even the time, the mileage that you can attribute to different clients. And there's a standby fee where if it's just sitting in your driveway, because it's available for personal use, you can't deduct it during that time either. So it's a little bit more complicated than that. Back to the mention I did earlier about meals and entertainment, you don't quite get a full deduction for meals and entertainment in the, in the era of being able to entertain clients, simply because you're also getting a benefit from it. So it's not fully deductible to the business. Now, I would encourage you, as you're setting yourself up for self-employment, to segregate all of the expenses that are related to the business from the expenses that are yours personally. This can be done very easily by using a separate bank account. And eventually, as the business grows and the business itself creates, has a bit of clout and some longer term relationship with a bank, you might even be eligible for a corporate credit card. And this will make things much, much easier with respect to business accounting. Segregating the income and expenses by putting it in one account also makes it really easy for you to know, basically at a glance, whether the business is profitable. If the bank balance is going up, you're profitable. If the bank balance is going down, not so much. Okay. Now, please be careful when employing family members. You might recall a few years ago that there was an awful lot of discussion about the government's clampdown on people who were reporting income in the hands of their spouses and children. The term income sprinkling might be familiar to you. In a nutshell, if you employ a family member, you can't pay that person any more than would reasonably be paid to someone who is at arm's length from you. So you can't really split income perfectly if only one person is really the driver of the business. Similarly, if they are shareholders of your business, then people who are at non-arm's length, so immediate family, etc., they have to purchase shares in order to be eligible for the dividends. And even so, in case of an audit, the government could balk at paying a dividend, even if those dividends were prescribed or subscribed to by a spouse or an adult child. Please, so many small businesses are subject to audit. Please don't take any aggressive measures in this area. And lastly, I do want to spend a few minutes on how legal structures can help you in tax planning. As you may know, you can run a business in one of three ways. You can run a business as a sole proprietorship, where you're the business and the business is you, or as a partnership with one or several other people, or as a corporation. The most efficient tax structure to use is the corporation, because it actually creates a separate taxpayer in the eyes of the Canada Revenue Agency. The rule of thumb of knowing when to incorporate is that when your business turns a profit such that you can leave money in the corporation that you don't need for your own expenses, that's a great time for you to incorporate. If you are running the business at a loss, meaning you are investing in the business and that you're not yet turning a profit, or your profit is completely withdrawn by you for your own purposes, for your own expenses, you can run it as a sole proprietorship and you'll still reap a slightly better benefit. Okay. With regards to creditor protection, when it comes to creditors, not all businesses are vulnerable in this area. And many, like mine, require that you maintain errors and omissions insurance. So before you go about creating a corporation, which does require a little bit in the way of additional accounting costs and things like that, find out if you're vulnerable in this area. Confirm it with, let's say, a corporate lawyer or a corporate accountant to see if the type of work that you do would require you to be protected in this way. The truth is that creditors can still seize personal assets like your home in situations of gross negligence. So the corporate veil is not foolproof. Really, the primary reason to incorporate is because as an owner operator of the business, you exert complete control over how much you're paid, when it's paid, and the type of income you collect. As the owner operator of a corporation, you would basically wear two hats. On the one hand, you could be an employee, which would entitle you to a salary if you want to take one, and benefits. But you're also an owner of the business or a shareholder. And this is really no different from someone who works at a bank and, let's say, also owns shares of the bank, with the exception, of course, that you have quite a bit more control over the direction of the business. When I say greater control, I'm referring to the fact that if you want to, you could choose to collect only a salary or only dividends or a mixture of both. But any money that is left in the corporation is actually taxed much more leniently than it would be if it was paid to you. If we're looking at, this is the tax tables for the 2021 year, if you're an owner of a business and you collect salary, you're going to be taxed basically in this column. This is the other income is reflective of salary. If you're taking dividends and dividends that are produced by business income, you're going to be taxed in this column, the non-eligible dividends. Keep in mind though, look at the numbers we're looking at here. In the previous one, let's just go back here, the lowest tax bracket for this person is 20%. If I told you the corporate tax rate is between 9 and 14%, you can imagine that leaving money in your corporation can provide you with an awful lot of tax benefit. And that's what makes it so very attractive. Now, when people are deciding perhaps on a mixture of salary and dividends, many people will think of things like securing the Canada pension plan, which can only be done by salary, or RSP contribution room, which can only be done or earned by paying yourself a salary. And then once you've reached those levels of maximizing the Canada Pension Plan contribution and earning a little bit of RSP contribution room, then switching perhaps anything in excess of that, you would be paid in dividends. But these are all, accounting entries for the most part. So you're going to want to work with your financial planner or with your accountant on these. You do want to be careful if you're leaving too much money in the business because investments that are built into your corporation, by investments I mean actually stocks of an investment portfolio, they can have a whole other tax treatment and be very complicated. But very often people will leave money in their corporations to smooth out, let's say, future leaner times so they can still pay salaries to their employees, if times get lean, or for research and development. That's what a lot of the retained earnings in a company can be used for. At any rate, you want to be very strategic in how you get your money, how it's taxed, and when it's taxed. And there is no greater control that can be exerted apart from the corporate tax structure. Now, before I take questions, I just want to remind you of a few things. The deadline this year for RSP contributions is March the 1st. Your tax reporting deadline is the 30th of April for individuals or the 15th of June for corporations. And that is actually, the April 30th deadline is also the time when you have to have paid any taxes owing by. So let's take a minute. I'll ask Mark and Louise if they wouldn't mind helping me address questions, and then we'll summarize with a few of the resources that I'm going to share, as well as, how to get more information. Mark, are there any questions I should address?
Yeah, I have a few for you.
Sure.
Great session. Thank you very much, Monique.
Please.
Just a comment right off the top. Someone mentioned in the comment table that there's great apps to track business auto use in kilometers. If there's anyone that would like to do that, there's some applications out there that are great for that and make it a little bit easier for bookkeeping purposes.
Super. And let me just pause there for a second. That becomes incredibly important. You know, technology is amazing. When you're in your car going to a client, as I mentioned earlier, you have to track the kilometers that are related to a particular client, as well as maybe, you know, if you have a meal on the road and things like that. So any way that you can make it more convenient for yourself to track those particular items would be terrific, especially because on occasion the Canada Revenue Agency will choose different topics to pull for audit. And definitely home use in the in the past has been amongst them. This year there might be a little bit more lenience, but the next most common one that gets abused is the use of a car. So that's an excellent point.
So questions. The first question that was brought up was, does the medical expense tax credit apply when you already have medical benefits?
Great question. So to the best of my knowledge, and you would want to double check on the website, but to the best of my knowledge, premiums that you pay for group benefits are not eligible for the medical expense tax credit. Anything that is not refunded to you is eligible. So for example, if you're in a group benefit plan that excludes vision care or excludes orthodontics or orthotics, anything that's excluded, or if you've hit a maximum and you have extra costs that haven't been covered, those would be the ones that you would use for the purpose of claiming the medical expense tax credit. But as I said, one of the links, it's actually in the next slide, and I'll just move on to it just so we can address some of these things. Right there, you'll see eligible medical expenses. That's the site that you would go to confirm.
Next question. Someone had a question around the cutoff period for home office expenses. So they wanted to know if it was in December 2020 or February 2021, similar to the RRSP contribution timeline.
Fabulous questions. So with the exception of the medical expense tax credit that I mentioned, where you can choose the 12 months that you want to report, provided that they are consecutive months, everything else really goes by the calendar year. So the one that, when we're talking about home office expenses, they would end December 31st of this past year, because we are reporting for the 2020 tax year. What will come of our 2020 tax return, that remains to be seen, whether the costs incurred from January 1st of this year through to the lifting of the pandemic, what will happen. But for the purposes of the home office calculator that I've given you, we're really looking for the expenses related to the tax year that you're reporting, which is 2020.
Perfect. And just a follow-up question to that is, should the more advanced method of claiming expenses be used on a per household basis or as for each individual?
So it's a good question. I was just talking to my husband about this morning, because he's an accountant. And I don't know that there's been a lot of clarity offered yet. So with regards to the flat rate, as far as he's advised me, take it as you will, that can be done on a per employee basis. But it's probably inevitable that if you don't have a dedicated workspace, if you're sharing the space in a condo, for example, like I mentioned in the example, perhaps one person is sharing the dining room table on one end with someone else, chances are there will be overlap. And I would presume, although I would like you to take a look further at the link that I've given, I would presume that it's based on a per employee basis. You will want to be careful when you claim. Remember, at the beginning of the calculation that I showed you, we were talking about whether it's a dedicated space or not. In other words, is this a dining room table, or is this a spare bedroom that's only used for office type work? It wouldn't be too hard to be audited if both spouses claimed that it was a dedicated workspace, but there's only one space. You don't want to get yourself into trouble. So I don't know that there's been an awful lot of clarity about that yet, but you will want to be careful to whatever you're claiming should be defensible. Also appreciating that this is a brand new opportunity. So some of these nuances have not yet been confirmed.
Perfect. Another question. So for those that are trading stocks for those that are trading stocks, are your stocks investments taxed, and at which rate, or are they deducted from your income?
It's a great question. So let's parse this out a little bit. So investment income can be capital gains, it can be interest, or it can be dividends. So what the person who's asking the question is asking specifically about is capital gains. Capital gains are taxed, and they're taxed at the marginal tax rate, but not all of it is taxed. So I don't want to use jargon, but let's just say that if you buy a stock and it has appreciated by $1,000, you will report for tax purposes $500 in capital gains, half of the capital gains or half of the appreciation. So you will pay tax at your marginal tax rate. Again, I hate jargon, but this is the way it works. You'll pay tax at your marginal tax rate on half of the appreciation. So that's the way that would work. Now, there is another little monkey wrench, which is if you have also sold something at a loss in the same year, you would only pay tax on the aggregate, the total net gain or net loss. So going back to the example where someone's stock has appreciated by $1,000, if they sold another stock that depreciated by $1,000, there is no tax to be paid. The net gain on those two transactions would be zero. So suffice it to say, it's a slightly more involved answer, but the good news is the tax software will go through all of it with you, and you really do, the reporting that you get from your brokerage, even if it's a robo brokerage, is usually quite good also, and it will help you with some of this reporting.
Awesome. And I guess a follow-up question to that from the same individual asked if they had funds sitting in a trading account that have not yet been invested into a stock. Would that be considered part of normal income?
Normal income? No. So anything that you're putting into an investment account is already tax paid, right? So if I have, let's say, an extra $5,000 that I want to put into an emergency reserve, if I'm an employee, that money has already been taxed. That's what my source deductions are. Once it hits my bank account, it's mine to use. Although, of course, at the end of the year, I might still owe tax or be refunded. But if you're asking with respect to just a regular bank account that earns, sadly, pittance in interest, you will get, if it's large enough, you will get a T-slip, a T3 or a T5 for the interest earned on the bank account. But beyond that, the original capital that you're investing, if it's in a regular bank account, that's already been tax paid money. So no, you wouldn't have to report anything on that.
Okay, perfect. Another one for you. When starting a new business as a sole proprietor that's sales and commission based, can anything be written off if you haven't yet garnered any revenue?
That's the question. So when I mentioned earlier about the sole proprietorship, this is exactly the question to ask. Essentially, when you're starting out and you're not yet turning a profit, you do want to be in a sole proprietorship precisely for that reason, because let's say the costs of setting up your office, the costs of advertising, the costs of networking, if you're going to conferences and things like that, you are putting more into the business than you are taking out of the business at that time. And the good thing about a sole proprietorship is that the losses, the monies that you are investing into the business that is not coming back to you as income, can be deducted against other sources of income. So, for example, let's say you are working full-time and you have a small side business making something. And that side business, let's say you are investing in it, you're knitting, for example. So you're buying yarns, you're buying patterns, you're buying equipment, but you're not turning a profit yet. The money that you've invested in your knitting business can be deducted against your income from marketing if you're in a sole proprietorship. If you had incorporated, you would have lost the ability to do so, because inside a corporation, losses, in other words, investments into the corporation, can only be deducted against the business's income, which is precisely why, until you're turning a profit, you want to be running a sole proprietorship.
Awesome. Thank you very much, Monique. Another question.
Why do I think some of these questions are coming from you, Mark?
No, definitely not. Mine are at the very end. Can an unemployed spouse claim for job searching expenses, including office expenses?
It's a good question. I'm afraid I just don't know. I have heard in the past of someone who was laid off mid-year claiming things like the premium membership for LinkedIn against their income from earlier in the year when they were employed, but I'm not sure that I know that question precisely. I'm sorry. See, I shouldn't have made a joke,
no
Mark. Now I don't know the answers.
No worries. You can do a follow-up on that one.
Yeah.
Another question about the home office expenses. If you work from home at a kitchen table and it's a shared space, how does that affect how much of the tax return you'll receive? And if that kitchen table is in a large kitchen living area that's the majority of your apartment, are you able to claim the entire room? I pay rent on a condo.
It's a great question. So the rule of thumb is you want to make it, you want to have an idea in your mind of a reasonable square footage that is dedicated to the home. So for example, and I can picture sort of a largish studio or bedroom, a 1-bedroom apartment where, the dining room or a coffee table could comprise a fair amount of the square footage of the home. You just want it to be reasonable. So, if you're looking at a 900 square foot apartment, of which there is a bedroom that's probably not being used for that purpose, a kitchen that is probably not being used for that purpose, but a dining room that is, you might want to say, well, let's say 20%, 15% of the condo's square footage is being allocated. You just don't want to be particularly aggressive, because while I'm sure there will be some lenience offered to people in tax reporting this year, you don't want to be caught in a situation that if you were audited, that it's not a defensible deduction. So just be careful. But yeah, you'd want to make some sort of a reasonable estimate. It's not something that I would engage an accountant for off the bat if that's all you're asking. But at least make the claim somewhat defensible if someone were to ask.
Perfect. And I think, Monique, we probably have time for one more question. I just want to be respectful of everyone's time.
Sure.
Are there any additional tax incentives for students who are taking classes online in 2020?
So tuition expenses can be deducted against other income. There are a lot of different situations involved in that, and primarily most of them involve full-time students. But CE credits and things like that are often also eligible for it's actually a credit, forgive me, it's not a deduction, it's a tuition tax credit. So you can look online, there's plenty of information on that, because there is the assumption that people are retraining or upgrading skills at all times. Okay, so let me, Mark, then just wrap up. For those of you who found this particular webinar interesting, at UPotential, we actually run a regular webinar series, and my next one is February 23rd at 10:30 Eastern, and it's on not so well-known RSP strategies. So please feel free to join me there, and you can go to the UPotential website for more information. And if there are other questions, there's so much involved in this, and we do have to be respectful of people perhaps who have to leave at this point. Feel free to send me an email or give me a call. It would really be my pleasure to help in any way that I can. And I have to say thank you so much to the NABS Nation and to the organizers for inviting me to talk to you today. I hope that this is a seminar that's perhaps given you a little bit of comfort knowing that you do have rights in the Canadian tax system, and that even when we on occasion make an error, you know, you can always ask for help by the Canada Revenue Agency and the professionals out there. So if I can be of any help, please don't hesitate to contact me. And once again, thank you so much for your time and attention today, and for NABS for sponsoring the webinar.
Thank you, Monique. That was great. And everyone, we're going to email you a copy of the presentation, a link to the recording, and we'll do our best to answer some of the other questions that came in that we just couldn't answer due to time constraints and being respectful of everyone's schedule. So go have a great day, and thanks for joining us today.